Question number 4 talks about a factory which is manufacturing 3 products P, Q and R. So, the budgeted result is provided for sales along with the PV ratio. Fixed overhead is given. The management is not happy with the result and it says prepare a statement of profit or loss and suggest in what way the sales mix should be. So, this question will take you to finding what is called combined profit volume ratio. So, PV ratio what we have calculated in the earlier question was about one product, but when you have more than one product, in this particular question you have 3 products, there the calculation will be little different. So, let us solve this question together. Statement of profitability. So, product sales value in terms of rupees, PV ratio in terms of percentage and contribution in terms of rupees. P, Q and R. $2,50,000, 4 lakh, R is given 6 lakh. So, what is the grand total, friends? 12,50,000. The PV ratio is 50%, 40% and 30%, right. So, what is the contribution? Multiply this with this. So, 3 is equal to 1 into 2. So, 1,25,000, right. This is 1,60,000, this is 1,80,000, right friend. So, this becomes, if you add 4,65,000. Now, less fixed overhead, this is 5,02,200. So, there is a loss of 37,200, there is a loss. Now, what is the aim? You have to recover this loss. To do this, you need to have additional sales. So, what this question says? It says you must have additional sale. So, P, Q and R. This is 37,200, this loss in each of the product has to be recovered. So, what is the PV ratio? 50%. So, divide it by 50%. What is the next for Q? 40%, divide by 40%. What is here? 30%. So, when you solve, this becomes rupees 74,400, this becomes 93,000, this becomes 1,24,000. On solving, this particular thing, this is the additional sale you have to make, and total additional sale to maintain same sales mix, what you need to do to total sales to maintain same sales mix, what you need to do, you have to find combined PV ratio. So, what is combined PV ratio in this particular question? So, combined is total contribution by total sales into 100. So, the value is 4,65,000 divided by 12,50,000 into 100. This comes out 37.2%. Right, friend? Have you seen the calculation? Have you understood? Now, the line was total sales to maintain same sales mix. You need to do the calculation. You have got combined PV ratio. So, it will be 37,200 divided by 37.2%. This works out to rupees 1 lakh. So, rupees 1 lakh needs to be the additional sales. If you can make 1 lakh extra sale, you are in a position to solve the worry of your management, because then there will be no loss. I hope, friend, you have understood question number 4, which uses the principle of combined PV ratio, and to get that figure we have divided each one of the element here with corresponding PV ratio. So, loss is divided by PV ratio of each factor, which gives you the desired data required by the examiner. So, step by step marking is there. You have to solve the question with grace, slowly, accurately, no hurry. So, what is more important in the exam is to understand the question, understand the requirement of the question. Decision making and cost analysis. This covers roughly the marks ranging from 30 to 35 marks paper in each exam. So, friend, if you are doing operation research, CVP analysis and marginal costing, and decision making with cost analysis, you are doing almost 65 marks out of 100 marks. Decision making are of numerous types. I am going to cover the maximum possible types of decision making. We have already done 7 types of decision making. The 8th decision making which we are going to take up is decision on lease. So, you have to evaluate if you get lease money, lease rental from some source, whether this is going to be useful for your short term business decision purpose. So, let us do decision on lease as the next discussion area, and we will be doing question number 15 covering it. So, What is lease? Lease is a word which you have seen in direct tax, in your financial reporting as well as auditing. So every business can opt for different type of models of getting revenue. Even in SFM, strategic financial management, lease is a specific topic which has been dealt. So I won't go into that discussion. I will straight away focus as per requirement of the short term decision making of the business. So lease rental is an area where a company can receive money from a given decision which it takes. So let's read the question, try to understand the requirement and solve it. This question has three parts and the third part deals with lease rental. So friends, the question says a company is manufacturing three products whose cost detail is given. For each of the three products, you have a selling price, you have a direct material, direct labor, variable overhead, explained with the word direct expense. You have contribution, number of units sold, fixed cost and what is the total profit. So friends, this business gets all its raw material imported from a foreign country. Now, it happens due to foreign exchange restriction, company can import only 3 lakh units of raw material, right? Earlier, it was importing total thing from overseas as raw material, but now it can only import 3 lakh units of raw material and the company can produce in all 1 lakh units by using all its product A, B and C. They can market 20,000 units of A and C. Now, 20,000 units each of A and C can be marketed and there is a local substitute material which is available in the market at rate of rupees 3.75 per unit. However, to get it, company has to spend 50,000 rupees on intermediary and consumable if local substitute material is used in the production process. So the question says that you have to use local material. In that case, you have to spend 50,000 rupees extra on the intermediary cost of the new process because you will be involving the local material. There is also a third party who was willing to take a part of plant on lease up to 50,000 units capacity of B and willing to pay lease charge of rupees 2,75,000. Now, management is seeking your advice. What is the advice they are seeking? What should be the quantum of production or sales mix of products with existing import restriction? So, when you are taking the imported material limited to 3 lakh units of raw material, what is the quantum of unit you can produce? The option number 1. The second option is whether the company can optimize production of 1 lakh units with local substitute material. So it says if it takes only the material which is locally available at rupees 3.75, what is going to be the revenue in terms of profit, in terms of the final gain which business gets if it takes this course. And the third option, which is a lease option, says whether the company can increase the profit by leasing out a part of the plant to the third party and restricting its own production. As a strategy, should company go for lease option and do some part production to outsiders in a way so that outsider do the production using the lease option. So we have 3 decisions to make. Let's take the first decision. The first decision talks of how much is the quantum of production or sales mix of the products with existing import restriction. So let's do this first part with me, friends, together. So quantum of production. When you have import limits, right? So you have products A, B, C and create one column for total. Always in the examination, when you have multiple product, keep one separate column for total, even if it is required or not required, right? So you have selling price per unit in terms of rupees. You can create it like this. So selling price per unit is given at 35 rupees, 40 rupees and 50 rupees. You have also detail of variable cost per unit. Again, this is given at 25, 30, 35. So contribution per unit in terms of rupees. You can keep this rupee column here also, so that you need not repeat. So it's the style of presentation you have to develop in the exam. So this is going to be, if you subtract 10 rupees, 10 rupees, 15 rupees. Now the units of material, you need 4 units to produce A, you need 5 units of raw material to produce B, likewise you need 6 units of C, raw material to produce the C. So contribution per unit of raw material, right? Here it is 10 by 4, 10 by 5, 15 by 6, 2.5, 2 and 2.5. So your rank will be, the first rank goes to A and C and second rank goes to B. So the focus was to reduce price and give more qualitative product. So in that scenario, the management of the companies started thinking how to work on each process in terms of activity. So what was the normal costing? It evolved as activity based costing. So now the management was more thinking in terms of each process. It was thinking in the term of each activity. So how to work, how to reduce the cost, how to work on improvement of the quality. So all these aspects were considered into activity based costing. So this was one of the reasons which was required to take activity based costing into the picture. The globalization brought lot of competitive product from different parts of the world. So when our country was having the ambassador car, it was getting competition from a smaller car called Maruti, and 20 years down the time, more cars, Hyundai car, the cars from different part of world, they all started coming at reduced price with more features, with more advantages. So the business started thinking how to restructure the process in the way that each activity is improved on a regular basis, and therefore the price goes down and the consumer are in a position to buy the products. So I gave you an example of the car market. There are several other markets where this started happening. So what we conclude, that activity based costing evolved due to certain reasons. So the reasons are, or the ABC activity based costing was needed because of the growing overhead, right? Because you were costing on the basis of absorption costing. So you never knew whether the manufacturing overhead, whether the selling overhead, whether the administrative overhead, what has increased. So you were not knowing that the quality issue due to globalization was the second reason. Third was the competition, local and overseas. I gave you the example of the car, right? Another was accuracy of identifying processes wastage. So business was now more thinking in terms how to reduce the process wastage, how to reduce the scrap, how to modify the scrap. So lot of the thing was considered in this particular area. And finally, there was need to have decreasing cost and increasing value. Value means the features. Value means the need of the customer. Identification. So friend, this was the basis due to which activity-based costing came into the picture. Now, activity-based costing, can I link this to PERT CPM which we have learned, friends? You have learned that in the PERT CPM you have lot of activities. Now these activities, if they are linked on a cost and time diagram using PERT CPM and crashing, the same thing applies here. In terms of product costing, you have to provide why this product is going to give me good returns. If I can control the process of the that product, I am going to have benefits. So take one example to understand more clearly. I am making an e-commerce product. So what is an e-commerce product? You have lot of website based selling. It can be, you must have heard the name of Jabong, or you may have heard the name of Snapdeal. Latest to come in India is Amazon, and the hype in the market is created by Flipkart. So what they do, all of them, they sell through website different products. What are the activities involved in this particular business? If a company has to compete with the local product in the market, how it will compete? Take one example. I start selling car using this e-commerce website. So I will be offering more than the local companies. I will be offering insurance, I will be offering maintenance, I will be offering accessories, the needs of the car in that term. I will be offering sale, purchase of old car, sale, purchase of new car. Maybe I will be offering rentals on the car. So friend, what I am doing? I am trying to create process for each of the activity. So I have activity 1, activity 2, activity 3, activity 4, activity 5, 6 and 7. And maybe I will be offering helpline. So we have 8 activity where we are going to start the car business. So I create a website www.carbusiness.com, right? So in the traditional costing, what I will do? I will try to create different overheads. It can be selling overhead, distribution overhead, as this is a trading and service market, so we don't have a manufacturing overhead. Yes, we can have marketing overhead, we can have administration overhead. So when I will be doing my transaction, I will be including all these items into the process, right? This is not going to give me which activity is giving me more gross margin or which activity is not pursuing properly. Therefore, I will create something under activity based costing. So let's do that. So how we do it? We have certain steps. So what are the steps? We involve cost identification, right? Then we make basis of apportionment of that cost. Then we have that of such cost over job. It can be over product, over services, and over customers. This means I am going to create what is called activity cost driver. Another Japanese concept which came into picture was called just in time. Let us understand till now what we were doing. We have a factory, we were producing the things, these things were stored in our godowns, kept there, and then it was sold. So there was a holding cost involved in the stores, warehouse, where you have to pay for insurance, you have to pay for maintenance at the warehouse, the rent, the interest on capital employed. So all these add to your cost. When cost is increasing, how can you face the competition across the globe? Because it's not your homeland where your product is being sold, but you have scaled globally. What does this mean? This means two clear-cut things. First, continue evolving by offering world-class quality thing. Number two, cut your cost. So just in time is a method where holding cost is reduced to minimum. How? Let us understand how this Japanese concept works. So friend, I'll make one small drawing to make you understand how JIT or just in time works. Then we will move into the details of just in time. So I am making a factory. This is the factory, right? Currently the goods are going in the warehouse and using shipping cost method under transportation, which you have learned, it is sent to consumer. This is the current procedure which is happening in the developing economy, right? Now, another system which says, let's analyze and understand. So this factory needs input. Input 1, input 2, input 3. So these inputs are coming from various vendor. Vendor 1, vendor 2, vendor 3, vendor 4. So they are giving raw materials to the owners of the factory, which is stored internally, right? So this is the internal storage. Now you are incurring the holding cost because there is cost of storage. You have to pay interest on capital employed. So all these things are there, rental, insurance, and then you send to the shop floor, SFI, right? And after it is produced, sent to warehouse for sale. From here it is dispatched to the consumer. Now the Japanese system says something different. It says, let's do the thing this way. You need at 10 a.m. 22nd September 2014, 6,000 units of input raw material. I write RM for raw material. Now you have 4 vendor. So you will settle with one of the vendor the required thing. So the required thing may be spoken on 17th September 2014 and on such date at 10 a.m. maybe 9:30 a.m. these input material comes to the godown. Here the production people get the thing. So what you are finding? You are finding one very important thing. The important thing is this cost of storage at this place is reduced. So what it is affecting to your business? It is making the thing easier for the company because you are cutting down the cost. Now friend, let us understand how it affects purchasing department, production department and sales department. So here is purchasing, production and sales. Production I have told you by giving this example, right? I hope you have understood. Now in case of purchase, the idea was to get from all the 4 vendors different type of things of the best quality at right price. So you were procuring the thing. So there was an entire procedure involved. Now what is happening? You have created a pattern under which you are getting the thing right at the shop floor. So what is now good happening that your purchasing system is streamlined, production cost is reduced because there is no storage. Now how it affects sales? We have to understand this. Now there is a possibility that the thing which is produced here does not go into storage. It straight away goes to the consumer. What does this mean? This means you are again going to cut warehouse cost of sales. So you have noticed we have curtailed 2 costs. Number 1, we have curtailed the cost of storage of input material and also we have reduced or finished off completely the cost of keeping at godown the finished product. So with this understanding, let me go into the slides. So slide says this is a system where objective is to produce products or components as they are required by a customer for use rather than for stock. Very important point. This means you are not going to hold it within your internal storage place. So just in time system is a pull system which responds to demand in contrast to push system in which stock acts as buffer between different elements of system like purchase, production and sales. So what does this mean? A very important word which is coming is push and pull system. What does this mean? This means whenever demand comes, you are there to push the product to the consumer. Suppose the demand comes on 22nd September 2014. Next demand you don't know, maybe it comes on 12th October 2014. So what you will do? Will you keep all this input material at your location on a regular basis? This is not going to help because you are now incurring the cost. This cost is reduced under JIT system, which is a Japanese system.